A few weeks ago, we had Joel Landon on our podcast, and what that led to was we had so many questions about self-directed retirement accounts that we really just had to have him back for a question and answer session today to get all of our questions about self-directed retirement accounts out into one place so we can reference them for later. So you are listening to this video probably because you're interested in self-directed retirement accounts as well, or you want to learn more. So we're so happy to have Joel here with us and to get all of our questions answered so we can use these accounts and do private money lending or anything we want with them that he's going to share with us. So thanks, Joel, for coming on.
Yeah, happy to be back.
Yeah, thanks, Joel. I'm excited to dive more into this. I think it's going to be super informative and helpful for everyone. So thank you.
Of
So
course.
let's start at a very high level here for self-directed retirement accounts. So the very first question for anyone listening, just so everyone can level set here, is what exactly is a self-directed retirement account?
Okay, so a self-directed retirement account is a retirement account where retirement funds are held that you can then invest in alternative assets. Traditional retirement accounts are retirement accounts where funds are held that you can invest in the stock market. That's very common, that's very recognizable for most people who are familiar with retirement accounts. But the flip side is the fact that somebody can then take those same type of retirement funds and invest them in alternatives like private money lending, real estate, cryptocurrencies, tax liens, etc.
Okay, perfect. And what types of self-directed retirement accounts exist exactly?
For sure, you've got the traditional and Roth IRA, which an IRA allows any individual to participate in. You can make contributions annually, whether you are self employed or whether you're W 2. You've also got the solo 401k or the one participant retirement account that's designed for the self employed individual that allows them to make contributions, kind of like the IRA, but bigger contributions. Both of those, I should say the traditional, the Roth IRA, and the solo 401k, allow the individual to invest in alternative assets. There are also a couple of other type of self-directed retirement accounts that are less common, and that is the educational savings account, which is a custodial account. It's a tax deferred account. It allows you to make contributions and even self-direct and grow that balance with the intent ultimately to benefit a child and their education savings expenses, I should say, educational expenses. There's also the HSA. We're all familiar with the health savings account, something that hasn't been around forever or as long as a solo 401k, but it is a place, a tax deferred account where you can make contributions for health expenses, of course. Great tax benefit, but at the same time, you can actually have that money custodied and the assets within it so you can invest in alternative. Less common in the self-directed space. Balances are typically lower because the contribution limits are lower, but they are out there in the marketplace.
Okay, so a lot of options here. And to make sure I understand correctly, so the self-directed IRA and a self-directed solo 401k can either be traditional or Roth for both options. Is that correct?
Yes, so it's really important to note that on the solo 401k side, the way that those accounts are designed by Internal Revenue Code, they allow the participant or like the beneficiary of the money within it to actually hold a combination of pre-tax, Roth, and after-tax funds. So all of that can kind of float around inside the one solo 401k for the one participant. On the IRA side of the house, you have a traditional IRA and a Roth IRA. There's a hard line in between both of those. So a Roth IRA cannot at one point hold traditional or pre-tax retirement dollars. It would have to go from a traditional IRA, which is pre-tax funds, converted and moved separately into a Roth IRA. Or organically, you can just make Roth contributions to a Roth IRA. So IRA side of the house, very separate, very distinct accounts. Solo 401k actually allows you to hold all types of funds, whether it's pre-tax, tax-free, tax-deferred. You could hold all of that in the one solo 401k.
Okay, perfect. And just as a reminder, can you just remind everyone the differences between a Roth and traditional, like what that actually means in real life?
Of course, yeah. So the traditional funds, if you will, retirement funds, are pre-tax dollars. They are funds that have been contributed to the retirement account itself prior to any taxes. And it's also referred to as, tax deferred retirement funds. Ultimately, it just means that the individual has the luxury to grow that money and not pay any tax on it until distribution, which is typically around 59 and a half. And of course, depending on your tax strategy, your taxation at distribution could look very different, especially if you're a high income earner and you're making those pre-tax contributions, if you will. It's really nice because it does lower the individual's adjusted gross income.
Mhm.
People like that. If they want to remain within a very particular tax bracket, they will make pre-tax contributions into a traditional IRA or into the traditional or pre-tax bucket of their solo 401k. On the Roth side of the house, that is specifically funds that have been taxed. Those are funds that you can grow tax-free into retirement. So let's assume I decided to take some of my pre-tax money that I've made contributions with over the last 10 years and convert them to Roth. It makes sense for me today to take on that taxable burden during the conversion process and pay the tax on that amount according to my taxable bracket, right? Then I know for the next, let's just say hypothetically 15 years, I decide to grow that converted Roth retirement fund in real estate or in private money lending, and it grows exponentially. At retirement, because those funds are Roth and all of the earnings are then Roth, I get to take distributions at retirement tax free. So there's a lot of luxury in investing Roth funds because all of the funds, including the gains, are going to be tax free at retirement. There's a lot of strategy that can go into that whole process that we haven't even touched on yet, but those are the two distinctions.
That's super helpful. Thanks for clarifying that. I've heard about 401ks and IRAs for years and years and years, but it feels like it's very new that I'm hearing about self directed retirement accounts. Why is that?
It's not as mainstream, Liz, or Andrea. There's unfortunately not a lot of, let's just say, marketing or media around the self-directed option because your mainstream retirement institutions don't offer this. So you think about Fidelity, Vanguard, Charles Schwab, even some of your bigger banks like Wells Fargo, Chase Bank, they don't truly offer a self-directed option that lets the beneficiary of the retirement funds invest in alternatives. So I will say this, over the last 10 years, companies like ours and others, in the industry, we are doing our very best to market, if you will, and expose the public to this offering or to this option. So it is becoming more popular, I would say, over the last 10 years. It's been around for decades. The option has been around for decades. But when we're competing with bigger mainstream institutional retirement systems, those systems are designed to fund Wall Street. It's just the nature of the beast. In fact, I will go as far as saying, and many would agree, retirement accounts, especially the 401k, was specifically designed to benefit Wall Street. It was designed to allow individuals, obviously, to defer taxes, make contributions, prepare, quote unquote, for retirement. But legislation was developed to funnel that money into Wall Street. So you hear about that a lot, that the self-directed version of a retirement account is the idea of breaking free from Wall Street and moving into Main Street. And that's literally what people are doing. They're moving into more Main Street or more private, if you will, private placement.
Yeah, I think that context and historical information kind of helps everyone understand, right? Like why we always hear about the employer 401ks and
Yes.
not necessarily the self-directed retirement accounts. So with that said, at a high level, why would someone want a self-directed retirement account? Or who would you say are the people that would be the most interested or would make sense for them potentially?
Yeah, it's the individual who's been exposed to private placement opportunity. I think about the individuals who are exposed to what you and Andrea offer, Liz. They somehow came across your information. Maybe it was in a Facebook group, maybe it was in a presentation that y'all done or a meetup. They come across the opportunity that they may not have been exposed to, previously. They like what they're hearing. They like the opportunity. They know that they need that financial tool to now participate with their retirement funds. Those are the people. They run into the opportunity, so to speak. Those are the individuals that want to self-direct. You do have another bucket, if you will, or another type of individual that is genuinely looking for freedom outside of Wall Street. There is a following, there's a group out there of individuals, a big group that just want to break away from the concept of big business and Wall Street, and they would prefer to invest in more Main Street or private opportunity.
So you're talking about Main Street and private opportunities. What things can I actually invest in through a self-directed retirement account compared to my 401k through my employer? And is there a difference?
Yes, I do sometimes like to paint the picture of, that scenario. You're driving downtown, or maybe you're driving across town, and you recognize that there might be, let's just say, an apartment complex that's being completely renovated. I'm sure we've all driven down the road and we've seen a complete renovation on an apartment complex. Maybe you've watched it full cycle as you're commuting to work over the last year and a half. You watch it go from kind of crummy apartment complex to then like a beautiful, like, oh my gosh, I wouldn't mind actually living there and renting from there. We've all, for the most part, have seen something like that. That right there is almost always, I'd say 9 times out of 10, funded by individuals that are listening right now. They're funded by individuals who are willing to commit some of their personal savings account as an investor to help renovate that real estate property with a return on their investment, right? They take it from its low value, they increase the value, and ultimately they receive a return on their initial investment. People do that all the time with their retirement funds as well. They see the opportunity, they run into the opportunity because maybe their friend is actually running that renovation. They say, how can I get in on that? Those are classic real estate investment opportunities that a lot of people run into and a lot of people gravitate to because they're just so dang lucrative. So I would say real estate takes they take the claim, honestly. So I would say real estate, private money lending. I know that that's an industry that you gals are a part of, and that's also tied to real estate. The nice thing about private money lending for a self-directed user is the range of opportunity. And that's what I've seen in this industry over the last 8 years is the range that the individual has to come in and commit as an investor versus maybe some of the other private placements where that barrier to entry is a lot higher than most.
Perfect. Thank you for the explanation, as always. So, let's say I'm interested in setting up a self directed retirement account. What type of money or previous accounts can I roll over to start a new self directed retirement account?
For sure. So it's a bit of a list here, and I'm just going to read them out because somebody listening today might need to hear this. If you were or are a government employee, maybe you've participated in the armed forces or our United States military, it is likely that you are a participant in a TSP, a thrift savings plan. Those, we have a lot of government employees, we have a lot of armed forces individuals. So that's actually a very common retirement account that you actually have access to if you severed your employment with the government, or if you have completed your full term as a military professional. Those funds can actually move from your TSP. I do it all the time for clients into a self directed retirement account. Okay, there's a lot of other company sponsored plans. The most common, and they all are called or named after a tax code. You've got the 401k, the 403b, the 401a. Those are very, very common company sponsored plans that are designed for the participant employee. If you've severed your employment from any of those employers that offer that plan, And maybe you've even moved on to another employer and you've taken those funds with you and you've added them to your current company sponsored plan. Those funds are actually eligible. So again, if you've severed your employment from those companies that offer those plans, whether or not you've moved them into an IRA or they're still sitting there with that old employer, or maybe you've bundled into your new plan, you can roll those funds into a qualified solo 401k or self-directed IRA. I'll finish it up with traditional and Roth IRAs. A lot of people will start those, because their CPA told them to start making contributions to a traditional or a Roth IRA, depending on the situation. Those individuals can take those IRAs that are truly just maybe sitting there in a Fidelity brokerage IRA or maybe even a Wells Fargo IRA. I used to work for Wells Fargo and I'd see those all the time, just an IRA plugged into a savings account with nominal interest. You can move those, we can transfer them to a qualified self-directed retirement account.
Okay, that makes sense. So we talked about how to roll over previous accounts for self-directed retirement accounts, but what if you don't have a previous retirement account? Can you still have a new self-directed retirement account?
Absolutely.
Okay.
Absolutely. Yeah. Would you like me to break down that scenario for you?
Yeah, that'd be great.
A lot of individuals have actually heard about a self-directed retirement account and they've never put money away, but they're ready to start today. That's totally fine. There are contributions an individual can make every single year to a self-directed IRA. It changes every year. So depending on who's listening to this and when, you just need to go find out what those annual contribution limits are for the year that you're going to make the contribution. A perfect example is this year right now, I can make a $7,000 contribution to an IRA with my own W-2 income if I wanted to, and I could do that with pre-tax or Roth. I could then have access to that money and grow it with you. I could honestly ask you two ladies, hey, be on the lookout for an earnest money deposit transaction that I can jump into with my $7,000. Or, maybe I can jump in as a partner, as a private lender. You name it. Now I have access to actually self-direct those funds. If I was a small business owner, if I was even W-2 and I'm moonlighting, or I do some side consulting, or maybe I'm a full-fledged, full-time self-employed individual. If I take a salary as a self-employed individual, I can now make employee contributions, just like my friends who are W-2 with their company sponsored plan. I can make employee contributions up to $23,500 for this year. Oh, and I can also make a profit sharing contribution up to the maximum for the year. So if I decide to take some of the net income of my business and it's a part of my tax strategy with my CPA, cool, I'm going to make a profit sharing contribution, big benefit for my business. And at the same time, I'm growing my solo 401k. And I'm going to take all of those funds now and I'm going to go invest those. So, yes, to answer your question, significant tax benefits and contributions that I can make, even though I have no funds to roll over. And let's just say this last part here. If my wife was also self employed with me in my business,
Mhm.
she can also make the same amount of contribution. So we are doubling our solo 401k balance because the Internal Revenue Code allows me and my wife to participate in that one plan and make the same amount of contributions to go self-direct and invest.
That's really cool. So you kind of alluded to this already, but you mentioned past employers. So let's say I've been a loyal government employee or a loyal employee to one hospital the whole time I've been employed. Can I take the current funds from my current employer, or does it have to be a past employer in order to turn it into self-directed?
Short answer is you cannot. In some cases, however, Andrea, there are professionals or employees that have potentially reached a threshold with their employment and it's written into their company sponsored plan that they can actually roll that money out while they are still employed. It's very rare,
Mhm.
but some of you listening today might actually be perking up right now because maybe you received a notification or the rules already that you can actually roll money out in service. That's very rare. Now, individuals who have reached 55 years old should have the ability to actually move those funds. They call it the 55 rule, from a current employer's plan out into a self-directed retirement account. And that is not uncommon, meaning people like to do that because they don't want to wait till they're 59 and a half, and maybe they've only heard about self-directing at age 55, so they want to get an early start on it. So it's rare, Andrea, really good question, but we love working with clients that might suspect that they are eligible.
That's helpful to know that it could even be possible, because I thought the answer was a flat no. So thanks for clarifying
Yeah,
that.
of course.
You've also touched on this already a little bit, but I would love to dive just a little bit more into the tax benefits, if there are any, for self-directed retirement accounts.
Yes. I would say the primary benefits are the fact that an individual can choose to take earned income essentially and make contributions as a tax deferred tool, right? I'm going to lower my adjusted gross income by making contributions pre-tax. Or I'm going to decide to take that taxable hit today so that I can benefit from the distributions tax free. I will also mention, and this is one of many other strategies that a good tax advisor could really support somebody on, but there is the discounted Roth conversion that is very, very popular in the self-directed real estate investment space. The discounted Roth conversion is actually very simple on paper. It allows an individual to invest in an asset with pre-tax funds. So again, maybe, in fact, most of the time, funds that are rolled into a solo 401k or self-directed IRA are going to be pre-tax. Company retirement plans are kind of designed to help that individual make those contributions pre-tax. So you've got all this pre-tax money in a self-directed retirement account. Let's say you invest in a piece of real estate asset. Let's say it's that same apartment complex syndication that's having a massive renovation. You know for a fact that at the end of that project, there's going to be a significant gain in value. So what you can do, this is totally kosher, you can have that asset or your portion as a limited partner, right? Your piece of the pie, you can have that converted to Roth at the lower value before it increases in value. What does that mean? I essentially have a valuation on my portion of my investment comes in significantly lower than even my capital contribution or my capital investment, maybe even 20% lower. Don't quote me on that, but I'm just saying it could be based on the valuation valued lower than your capital investment. You have that converted. It's now a Roth asset, lower, again, converted at a lower value. Then once that apartment complex finishes its renovation and you get your return on capital, you get your gain, you receive your gains from your investment, all of that is now considered a Roth asset, or what you receive is Roth money. So it's a big tax benefit. Hopefully that made sense. Go dig into that. The discounted Roth conversion is a powerful investment tool.
Yeah, once again, sounds like a lot of options. So, probably a good idea to communicate with your financial advisor or CPA for what is best for you, right?
Definitely.
Yeah. Okay, great. So, if someone were to Google self-directed retirement accounts, one of the other things that may come up is prohibited transactions. So, can you go into detail exactly what this means?
Yes. So what I'll say is there are some very particular assets that are considered collectibles that are off the table. The prohibited transactions are investing in assets like automobiles. They could be even some collectible coins that are, not circulated coins. They could very well be artwork, rugs, paintings. Those are the types of assets that you do have to steer clear from. Not common, but there's obviously some investors that would be interested in investing in those assets. But the prohibited transaction is probably more associated with the disqualified individual. And what does that basically mean? I cannot invest, or I'm prohibited from investing in an asset that is directly managed or influenced by an operator who is someone in my direct lineage. Let me break that down. So if my wife or my parents or my children, those are the people in my direct lineage, and even myself, if we were in some way, shape, or form operating or managing or having any type of decision making powers over an apartment complex renovation, I would not be able to use my self directed retirement funds to invest in that. So that's just the way legislation, Internal Revenue Code, and publications were developed. They don't allow me to invest in those types of assets that are controlled or managed by anyone in my direct lineage. So you've got those prohibited assets, artwork and so forth, but it's more closely associated with stay away from the assets that are tied to you and anybody in your direct lineage. And we get that question a lot. And we get people that want to actually do that more often than not. They want to take their retirement funds and invest in their real estate syndication because they're the general partner. They believe in the project. They want to show they've got more skin in the game. Unfortunately, they can't do that. They need to go invest with their friends' syndication.
Yeah, that's helpful to understand. And I'd love to work through maybe a couple of examples about this. So, you're talking about big time projects, syndications, that sort of thing. Does that apply to an individual home also? Like, let's say I have a property that I want to fix and flip, and maybe there's a chance, maybe the plan is to sell it afterward, but also the plan could be to hold it as a rental. Is there any way that my self directed retirement account could be involved in that process?
Yeah. So, no, I guess the short to answer your question specifically, no. And I'm so glad you brought this up, Andrea. Let me dive into that, if you will. So, let's just assume, Andrea, that you actually wanted to hold a short term, you love to travel, a short term rental in a beautiful part of, let's just say Central America. And that is totally fine. You can hold that asset in your solo 401k or in your self directed IRA. You can rent it out. You can collect some great recurring revenue on that. However, knowing that you love to travel, Andrea, you would never be able to stay in that property in Central America. A lot of people want to do that. They want that to be a property that their family can even go vacation in, but that's hands off. So that's a really, really good scenario. Another scenario that's similarly tied to that or close to it is, let's say you found a short term rental in a beautiful part of the South, and you want to renovate that property because it has potential and that you can get that on the market within the next 6 months.
Mm.
Maybe you are a flipper by trade and you know how to take a property and spruce it up. You can't do the work if you decided to buy that property with your solo 401k. You'd
Mm.
actually have to contract everything. In fact, you'd have to get a property manager to run that short term Airbnb going forward, because the idea is that you cannot associate your own self or your work with that asset. You have to allow somebody else. I always like to say you have to be at arm's length from that investment.
That's helpful to understand because it's very nuanced in there, right? And so, with your initial answer being no, as far as, being able to own the fix and flip, but then actually maybe the answer is, it sounds like yes, as long as I didn't have a main role or any role in that process. Am I understanding you correctly?
Yes, I love how you put that. You cannot have a main role. You can't have that main character moment. You've gotta be that like co-star, you know what I mean? You've got to let the professionals come in and do that. And that can be so hard for people who have all the right tools and resources to do it affordably. They just need to make sure that somebody else is doing it.
Gotcha. Okay. And then I think I know the answer to this question also, but let's just clarify this as well. From a private money lending standpoint, so let's say now it's not that I'm just owning the property and the whole thing, that process. But from a private money lending standpoint, let's say that my dad came to me, or my sister came to me, maybe sister's allowed, dad or kid came to me with a property that they want to buy themselves, and they are asking for me to be a private money lender on this property. Is that allowed in that instance?
No, because I'm going to assume at this point that they are the main operator
Mhm.
of that investment. If your family member, your sibling, was a participant as an investor with very limited powers, right? You've got the general partner mentality and the limited partner. If they were a limited partner and you guys wanted to go in together as investors with no control over the operation, totally fine. But if it was your sibling that was, maybe they needed the funds to invest in the asset itself and you wanted to lend to them, you could not do that. You can't, you really do need to stay away from that. And I will say this, although there are some really firm publications that say, do not invest with or do not invest in an asset that is controlled or managed by anybody in your direct lineage. You don't want to play around with the gray area because in a lot of cases, that's where you could get in trouble. And maybe there's new tax law that's developed because of your specific instance that was questionable. So never invest in anything that could be questionable. Don't get me wrong. And I don't want anybody to interpret. There are family members that will invest in an asset uh, at, simultaneously,
Mhm.
both as limited partners, no control over the investment.
That's so helpful. Thanks for clarifying some of those examples because I feel like, once again, that it's very nuanced. And so just wanted to make sure people were kind of understanding what that means exactly. So, what is a custodian for a self directed retirement account?
So the custodian is essentially the company or the entity that is holding the assets within an IRA for benefit of the beneficiary. So IRAs were designed so that there would be a custodian, some entity that has essentially the wherewithal to hold those assets and to vet the asset, to do the compliance on the asset. It does simplify, if you will, the process for the individual investor because they don't have to worry about the compliance, if you will, behind the scenes. There's some form filings, some values that have to be reported, but it's ultimately a custodian is just an entity by design that holds all of the registered assets for the beneficiary. If you decided to invest in a fix and you have a promissory note, we as the custodian or the IRA administrator would actually hold for your benefit that promissory note as an asset within your IRA. It's very different than a solo 401k. There's no custodian for a solo 401k. So in essence, or in like theory, if you will, the asset itself, going back to that promissory note example, is held directly within the plan. And there's an administrator that's ensuring that that's a qualified asset and that the compliance is proper. And that administrator is actually the same person as the solo 401k participant. So I will say this while we're on this topic, the solo 401k is sometimes considered the preferred self-directed retirement account because that individual is controlling the whole thing. Whereas on the IRA side of the house, that's, there's a third party in there. The custodian is a part of the entire process. Some people like that security, if you will, or simplicity, but there's a trade-off, right? One has a lot more flexibility, whereas the other one, there's another party involved.
Okay, that's super helpful. And a question along those same lines. So let's say I'm a new investor and I want to set up a self-directed retirement account. Can you walk us through like operationally, like let's say I want to lend money as a PML on a deal, real estate, right? I know the closing date, and then I've been requested to go ahead and send my money in, right? So that the house
Yeah.
can close. So can you go through the differences of what this would look like if you have a solo 401k versus a self-directed IRA? Like, because what I'm envisioning is, oh, I have to go to the bank, I submit all these papers, there's going to be a lag, a delay. So can you just walk us through like realistically what this kind of looks like specifically with Heritage IRA?
Yes, absolutely. So you've essentially going through this hypothetical. You're at the point now where you're ready to go into business with the borrower. You are the lender. You would first need to submit what's called a bidirection letter. It's ultimately a document to Heritage IRA saying I'm ready to engage in a transaction via a promissory note and I'm the lender. It's about one page. You fill in the blank, essentially letting us know what type of investment it is. It's a promissory note. You're the lender. Once we have that, and we have the details of who the borrower is within that bidirection letter and where we need to send money. In this case, let's just say we have to send it to a title company, um, or some other third party intermediary to help facilitate the promissory note. Or maybe it's just sending it directly to the borrower. We just need to know that information. So once we receive it, we review it, we ensure that it's a qualified investment, right? You can private money lend, and as long as it's not somebody in your direct lineage, we will go ahead and actually initiate the wire to the borrower. So you can see you've got to essentially gain our permission with an IRA, us being the IRA administrator. We'll take your funds, we'll move it to the borrower, and now we have also a copy of your promissory note by then. So the bidirection letter, the promissory note, we've collected all of that, we've retained it, and now we have that specific investment registered for you. Obviously, your borrower is going to pay you back in installments, whatever that looks like. Those funds have to be redirected to your IRA. So it'll actually come back to us directly. We place it back into your IRA until you're ready to deploy it again. We value that asset every single year with you. We ask you what the value is, the current value, the market rate. We report that to the IRS. Those are some of the operational or the mechanics to getting your funds from A to B, right? With an IRA custodian or administrator. On the solo 401k side, it's a little bit different, because what you can actually do is just immediately, gather your promissory note from your borrower, come to agreement on the terms, and then immediately send out a wire transfer on your own. You could go to your bank account on your phone and you could wire the funds, the $50,000 to the individual borrower, and it's done. You give them your bank account information so that they can, let's just say ACH, or maybe even wire you the monthly installments or quarterly installments, whatever that looks like. So IRA custodian is involved in the whole process. You gain permission, we approve it, we send it out. That's like a 24-hour period. The solo 401k has that feeling of the checkbook control that allows you to just go and transact as quickly as you can get it done.
Okay, thank you. And just to be clear, you have to qualify for a solo 401k, correct? Like,
You
not
really,
anyone can just sign up for a solo 401k. Is that right?
that is exactly right. You have to be eligible with self-employed income. So you have to essentially prove that you have ongoing business or trade. That could be, like I mentioned earlier, maybe you're moonlighting after work hours, or you could just be a full-fledged self-employed individual, and you have to be able to pay yourself a salary from that self-employment.
Let's talk more about checkbook control because I've heard that term before and you've also mentioned it. What does checkbook control mean? And is it only for a solo 401k or does it also potentially apply to a self directed IRA?
That's a really good question. The solo 401k by design is considered checkbook control because there's no custodian. The IRA, by its own design, does not have checkbook control. So the idea that you can just take money from your IRA and move it over to an investment, it doesn't exist. Now, there are people that will circumvent this with an LLC or a trust. They'll actually create like a third party entity that they have control over as either the trustee on a trust or the LLC manager with the LLC. In our opinion, we don't offer that at Heritage IRA. We feel like that's a little bit of a gray area. If you're going to do something like that, be cautious, because now you're essentially holding an asset, which is either a trust or an LLC, right? It's member owned by your IRA. The custodian is actually, they'd have to be a part of the operating agreement, if you will. You could be floating around in a gray area because now there's an asset that you control, right? And it kind of goes back to that idea of you don't want to invest or have an asset within your retirement portfolio that you control. So I always like to just say, be cautious of that. Do your homework. Know that it's something we don't offer turnkey because there's potential risk involved with the idea that IRAs are designed to be held, for the assets to be held in custody by a third party, not by you directly.
All right, great. And then along the lines of comparing and contrasting the solo 401k and self-directed IRA options, if you once again Google like some of these differences, something that might come up is an acronym called UBTI. So can you define that and tell us what this means and basically the implications?
Yes. So UBTI is unrelated business taxable income. And that is, follow along with me. This is a lot of information. I'm going to try and keep it simple. That is essentially income that is generated from unrelated debt financed income. So let's break this down a little bit. If you took retirement funds and you invested in debt financed real estate, that debt financed real estate is going to trigger the UBTI. So now you're running into a situation where, based on the amount of financing with your real estate investment, your gains are going to be taxed according to the amount that's financed. If the real estate project that I brought up a little while ago was partly financed, let's say maybe 30 or 40% of that project was third party financed, uh, a portion of your gains are going to be taxed according to that percentage. So 30 to 40% of your gains could be taxed. And it's because of that debt financing. Now, the unrelated business taxable income is essentially that income that's generated from your investment that will be taxed that I'm referencing. This is very, very common. In fact, this is, you can't necessarily avoid it with a self directed IRA. Okay. Now, do some investors offset that UBTI, if you will, or that taxable income from some of their other losses personally? Sure, they have strategy with their tax advisor to help offset some of that burden because they know going into it that they're going to invest with their self-directed IRA in debt financed real estate. However, let's use that same scenario with the apartment complex renovation. Let's say it's a 3-year project and there's 30% debt financing from the local credit union who took on that opportunity to finance a portion of the project. If I walk into that investment as a limited partner with my solo 401k, there's actually a UDFI exemption. Again, that unrelated debt financed income exception, which means I can invest with my solo 401k in that project, in that hypothetical. My gains are not going to be taxed. It's not going to trigger UBTI. So a lot of folks will gravitate towards the solo 401k and they want it because they know it's going to come along with that UDFI exemption. In fact, there are financial coaches that I know of that really, really endorse the solo 401k and try to like get the word out there about that self-directed retirement account so that people can leverage it. But you do have to be eligible for it, just like you were mentioning, Liz. So you might want it, but you can't have it. Don't get me wrong. There are people that will actually go into self-employed consulting just to have a solo 401k. We've seen it hundreds of times. They have the wherewithal where they can actually take on throughout the year self-employed activities so that they can qualify.
Okay, so to summarize, just to make sure I understand, not everyone can qualify for a solo 401k. You have to be self-employed additionally and have revenue coming in, correct?
Yes,
And it may be easier, sounds like it's easier to avoid the UBTI. However, if you can't qualify for a solo 401k, then you can do a self-directed IRA in which it may be more difficult to avoid UBTI. Is that correct?
you hit it on the head.
Okay, perfect. And then the other thing that I would like to go into, another abbreviation here, is what is a ROB? So ROBS.
Yeah, that actually stands for rollover business startup. And that is specifically tied to a 401k, much like the solo 401k. So, what I'll say is there is a plan document, just like a solo 401k plan document. In fact, we offer this. And within that plan document, it allows the participant to take their rolled over funds from a from an existing 401k or company sponsored plan and invest those funds in their own business startup. So it's essentially, think of it as a provision that the IRS allows to help self-employed or individuals who want to start a business fund their own business with their own retirement account. It's not common. It's meaning it's not really something that's marketed often. You do see it marketed or circulated within franchisee and franchisor communities and consultants. They really like to offer that along with SBA financing, because it's hard for a small business individual to kick off a business without sufficient financing or funding. So think of it this way, Liz. If you wanted to kick off a franchise, maybe you wanted to open a Dunkin' Donuts. Who doesn't love Dunkin' Donuts? Maybe you wanted to have your own franchise and you needed $500,000 just to start. Maybe you can't get SBA financing for that. That happens. But you could roll over your old 401k into a plan document. Again, it's essentially a 401k plan document like the Solo 401k that specifically allows you to invest in your own business franchise. So it's a powerful tool, not just to get into the franchise, right, and to fund your own business, but it also gives you the chance to pay yourself a salary as you're starting this business so you can actually survive. It gives you the opportunity to actually grow your retirement funds, because if you think about it, you're investing in your business that in theory you want to scale and grow and reap the benefits of higher values. That goes right back to your own retirement value, right? If your business is growing, the value of your retirement investment is going to grow. And of course, yes, you have the option to essentially liquidate your investment, your retirement investment eventually, right? That's the idea. And so you can get back, in theory, your retirement funds to go reinvest in something else.
Wow, that's really cool. So, what are the fees typically associated with self-directed retirement accounts, and are they different with a solo 401k and a self-directed IRA?
Yes. So they are structured differently. And it's just because of the way that IRA administrators are designed and how a solo 401k is more of a self-managed service. The solo 401k at Heritage IRA is $1,500. I would say that's pretty much what you're going to expect to pay. It might vary by $500 either way. It's going to depend on the service that you're going to receive, right, from the company you're purchasing this solo 401k from. But expect to pay somewhere in the ballpark of $1,500 to kick things off. On the IRA side of the house, they're managed very differently. There's transactions involved where the custodian is essentially providing labor to get your promissory note registered, funds sent, etc. But what somebody can expect to pay for a self-directed IRA is about $450, $500 for the IRA. And that starts to grow each time there's another asset added to the portfolio. If a client has three separate real estate syndications as a part of their IRA, they may be looking at a $1,500 bill, because again, it's about $500, $450, $500 per asset held within that IRA. Those are kind of rough ballpark prices on the IRA, but at least it gives the listener a little bit of an idea of what to pay.
Okay, great. So I know we've covered a lot of information. We've talked about like who's eligible, how to set up accounts, what previous accounts you can roll over, the differences between a solo 401k and self-directed IRA, tax implications, prohibited transactions, disqualified individuals. So obviously there's a lot to go over here and to digest. So if someone listening is either like, hey, yes, absolutely, I want to sign up, or if they would like to learn more information and chat with you, what is the best way to get in contact with you or to learn more about Heritage IRA?
For sure. So it's the best way to reach me is via email, joel@heritageira.com. Heritage IRA is the name of our company. If you wanted to do some due diligence even before we connected, you could go to heritageira.com. And of course, if you're driving and listening to this, or if you don't have anything to write down, you could always just ask Andrea or Liz, and they will get you connected to me as well.
Perfect. I really appreciate all of your time for answering all these questions. And if anybody has any additional questions that weren't answered today, definitely drop them in the comments below this video, and we will make sure to get them answered by Joel, maybe with a follow-up video. So super appreciate your time. This has been so informative. Liz and I have both rolled over our and created self-directed retirement accounts this year ourselves. So we're still learning ourselves how to utilize these accounts in the best way possible. And you have been so helpful and instrumental in us doing that. So we really, really appreciate you. And thanks everyone today for listening to this video about self-directed retirement accounts. Hopefully all of your questions were answered. Hey there, it's Andrea. If you enjoyed this video, hit subscribe so you never miss another one. Thanks.